There's a huge amount of regulation in financial services, and in South Africa we're getting up to speed with something that's been happening a lot in the UK for the last 4 or 5 years. It's about this idea of treating your customers fairly, and the Retail Distribution Review, or RDR, changing the way in which you interact with your financial advisor. And it's really important because you have absolutely no idea probably how much you've paid in fees over the last 20 years. And the idea is that you get far greater control over the investment decision-making process and what you pay for it. At the Discovery Financial Planning Summit recently, Guy Bolam from BolamRose in the United Kingdom was on a panel discussion talking about RDR. And what's so interesting, and it's happened in South Africa to a lesser extent, is financial advisors had to write exams and suddenly had to be held to account for their knowledge. Right. And there's quite a big shake-up in your industry in the UK.
A real big shake-up. But you know, before RDR happened, the industry was full of fear. Since it's happened, it's been a breath of fresh air. Consumers, on the whole, are delighted with the step up in professionalism. You know, advisors are much more knowledgeable. Their breadth of knowledge is much greater. They're very much more professional, and clients have loved the fact that fees, charges are all transparent. The value chain in the UK is now quite separate. So there's distributors, manufacturers and advisors, and they are generally separate bodies, which has helped create this transparency.
But it's a really good thing. I mean, transparency is absolutely pivotal because in South Africa still we have something called the total expense ratio, which you would think would give you a perspective of the total expense, and it doesn't.
Yeah, it doesn't. So it sounds like it should, but it doesn't. You don't know where your pounds or rand are actually going, and therefore you can't judge what is good value and what isn't. So when the value chain is split up, or when the rand is explicit across the chain, the clients can judge, is it good value or not?
And something interesting that's happening in the UK is this move toward the real cost, the total real cost. You've got, over the next 20 years, I think starting next year, you've got to define to your client what the total real cost is. So that's not that's probably excluding their petrol to get to your office.
Yeah.
And that's about the only thing. And that way they can look at the investment returns they get, they can look at the costs, and they can then judge whether or not you're adding value.
Yeah, and total real cost, I think the jury's out at the moment, because that total real cost over 20 or 30 years, that's going to be a very big number.
It is.
And putting that big number in perspective against the returns and the advice and the you know, that attention that you've had from the advisor or advisor firm over all those years, putting value on that is very, very difficult. So connecting the two, I think, will be a challenge for the industry, and we'll see.
Okay, I mean, still the jury very much out on that.
Absolutely.
Is there a lot of pressure in the UK, as there is here, with people wanting to go direct, wanting to do index investing? We've seen Jack Bogle in the United States. I was at the Warren Buffett AGM recently, and Jack Bogle was in the audience, and Warren Buffett paid huge tribute to Jack Bogle for simplifying investments and making investments accessible to ordinary Americans and saving ordinary Americans billions of dollars. Now, that's surely a big risk in the world of financial advice.
Yes, it's a risk to the industry, but for the consumer, being able to go direct is fantastic. I think it's it's in everybody's favour. Where people won't go direct, though, is the increasing complexity of the tax system, increasing complexity of financial products. And at the end of the day, clients want to know that what they're doing is the right thing. They want reassurance. And for that reassurance, wanting and knowing what they're doing is right, they will happily pay the fee.
But at the same time, not everybody's going to be able to afford the fee. If you're charging per hour or per session or however the structure is going to work, that creates an advice gap.
And it's a massive gap. It's a huge gap in the UK. The mass affluent, younger than 40, before you've built up any wealth, are largely now unserved, which is not right. But the problem is similar in Australia, it's similar in the US. That gap is there, and it's a problem that the industry hasn't quite got hold of yet.
But the vast majority of us only wake up when we get to our 40s that life is finite, that money is finite, and your health eventually runs out and your capacity for work eventually runs out if your company doesn't kick you out earlier. So you've got this issue where younger people are not getting the advice, they're not building up the initial wealth, they're not getting to their 40s with any money, and what use are they to advisors then in the long term, because suddenly you don't have a supply line of future clients.
And then all of a sudden the money runs out, the advisors run out, and that is a big challenge for the industry. Young blood into the industry is key, but young blood that's trained well, ethical, open is key. And no market has yet solved that.
But what's happening in the UK, for example, if you've got a financial brain, the City of London beckons. And there was a brief period of 2008 where bright young people said, oh, I'm not going to work in that horrible cesspit, and then looked at the bonuses and went, hey, awesome. Can the financial advice industry compete against the sort of upside and the gains? If you've got a financial bent, City of London versus becoming a financial advisor?
You know, I think now becoming a financial advisor is a real healthy option as a career move. Because you know, professionalism in the industry has taken a real step up. It is a respected profession, which is very different from 20 years ago. In fact, it's probably more respected profession than banking.
Well, I mean, yeah, journalism compared to banking is a respected career choice. But the reality is that while people were very frightened of retail distribution review, as many people in South Africa are, clients I think are quite looking forward to it, but people like yourself, advisors, were really apprehensive. You were looking at projected incomes and going, we might have to take a little bit of a dip in income. And from a financial advice point of view, it's actually amazing that that virtually didn't happen.
It didn't happen at all. We expected a downturn in turnover of between 40 and 50%. We expected to be in a net cash neutral position after 3 years. The reality was turnover never dropped. But that was largely because relationships with clients became contracted. So clients knew exactly what they were getting for their money. They knew why they were doing what they were doing. And we delivered the service, we delivered the advice consistently. And consequently, the relationships with clients now are much better founded and will be long term.
We're in the second longest bull market in history, the longest one from 1987 to the year 2000. We've now been in a relative bull market, including in the UK, despite Brexit and everything else, from 2009 up until now. And the FTSE's been hitting record levels, and all indices around the world have been going up. RDR implemented in that environment has been great. What happens when inevitably markets must turn? It may happen in a year or 2 or 3.
RDR is great in whatever market, because we're not selling products now. It is all about advice.
It's the quality of your advice, and that puts huge pressure on you, doesn't it?
So quality of advice is independent of market fluctuations. So advice is not about you will do well in this or you will do well in that. Financial advice is about planning for the future, and whatever the market is doing, people need financial advice.
But do people, in a world where markets keep going up, and for many people investing for the first time in the last 10 years, they've never seen a down market, they've never felt the pain in the pit of their stomach, a year of negative returns. And as an advisor, you've almost got to be coaching for that without putting people off.
Every client interview, every new client that comes in the door, we stress time and time again, market drops, and it will happen. There will be a 10%, 20%, 40% adjustment at some point in your lifetime, maybe more than once. But you know what? We can manage that. And as long as the plans that are in place are flexible, the client will be fine.
Is anybody in Britain going to be able to afford to retire at the age of 65 in Brexit Britain?
So yeah, we're not alone. The rest of the world, people put off financial advice, put off saving till tomorrow, until it's too late. You know, on the plus side, people are living healthier, longer, working longer. So retirement ages, I mean, the state retirement age is pushing to 66, 67, 68, and it will probably, it needs to go longer, because the state can no longer afford to support that population, which is always growing. So I think people, although they may not like it, 40-year-olds now planning on retiring at 60 or 65, it's not going to happen.
Yeah, that was a baby boomer luxury, of course.
It was.
But does Brexit make any difference in terms of the prognosis for people's ability in Britain to have financial independence?
I don't think so, no. Yes, there will be twists and turns along the way. You know, it might be a hard Brexit, it might be a soft Brexit. It's more likely to be an in-between Brexit.
Of course.
So, you know.
Guy Bolam, thank you very much indeed. Nice of you to join us on The Moneymakers. Guy Bolam is a partner at BolamRose, a financial advisory firm in the UK. They've been through the process of what is called retail distribution review, which to most of you will mean absolutely nothing, and you're not likely to notice any big difference other than your financial advisor is going to say, let's negotiate a fee for my services. You're going to expect that from a lawyer, you're going to expect it from a doctor. Why won't you expect it from a financial advisor? It makes financial advice healthier all round. Thanks for watching The Moneymakers. Good night.